Every financial crisis has a trigger. 2008 had subprime mortgages, 2000 had the dot-com bubble, 1929 had margin debt. But 2026 is different because this time the risk isn't hidden inside one sector. It's sitting on balance sheets across the entire world. Trillions of dollars borrowed during the era of zero interest rates are coming due and must be refinanced at the highest rates in a generation. This isn't a prediction. It's already scheduled. And when refinancing replaces cheap debt with expensive debt, systems don't break suddenly, they tighten. Then they fail. From 2009 to 2021, the global economy ran on one assumption. Interest rates would stay low. That belief shaped everything. Governments borrowed aggressively because interest costs were negligible. Corporations refinanced constantly because debt was cheap. Households took mortgages they believed would always be manageable. And because monthly payments stayed low, the risk stayed invisible. But low interest rates don't eliminate risk, they delay it. They allow debt to grow faster than income, faster than productivity, faster than tax revenue. By the time inflation appeared, the structure was already locked in. A government borrowing at 1% can double its debt without doubling its interest expense. At 5%, that same debt becomes a constraint. Nothing else has to go wrong. The math changes by itself. Most people think crises begin when interest rates rise. They don't. The real stress begins when old debt expires, because debt doesn't disappear, it must be replaced. A bond matures, a loan rolls over, a mortgage resets, and when that happens, yesterday's cheap debt must be refinanced at today's rates. That's when balance sheets feel pressure. Not markets, not headlines. Balance sheets. A government that issued 3-year bonds in 2020 at near zero rates must now refinance at 4 or 5%. A corporation that borrowed billions at almost nothing faces double or triple interest costs. Emerging economies that borrowed in US dollars must repay with weaker currencies. Nothing crashes, but flexibility disappears. So why does 2026 matter? Because during the pandemic, governments and corporations issued massive amounts of short-term debt. 3-year bonds, 5-year loans, emergency financing designed for speed, not resilience. All of that debt sits inside the same maturity window, which means refinancing doesn't happen slowly. It happens together, across governments, across corporations, across markets. At the same time, if one country struggles to refinance, it's a local problem. If dozens struggle at once, lenders raise standards, not lower them. That's how liquidity tightens globally. Not because of panic, because everyone is refinancing simultaneously. This isn't a future problem. Refinancing is already happening. Across the world, governments are replacing debt issued at near zero rates with debt priced at levels not seen in more than a decade. Take the United States. Between 2020 and 2021, the U.S. Treasury issued trillions in short-term and medium-term debt at close to 0%. Today, that same debt is being refinanced at roughly 4 to 5%. Every 1% increase in interest costs adds hundreds of billions in long-term obligations. Nothing breaks. But fiscal room disappears. In Europe, countries like Italy, France, and Spain borrowed heavily when rates were near zero. Today, refinancing happens at 2 to 4 times the original cost. Budgets that once assumed cheap money must now absorb higher interest before funding anything else. And in emerging markets, the squeeze is sharper. Debt was borrowed in dollars. Currencies weakened. Interest costs rose. Refinancing isn't just more expensive, it's destabilizing. When refinancing pressure builds, everything doesn't break at once. Systems fail in order. Markets adjust first, quietly. Bond yields stay elevated. Risk premiums rise. Liquidity thins. This doesn't look like panic. It looks like hesitation. Capital becomes selective. Easy funding disappears. Corporations adjust next. Hiring slows. Projects pause. Expansion plans are delayed, not because demand collapsed, but because higher borrowing costs change incentives. Growth that worked at 1% doesn't work at 5%. Households feel it last, but most directly. Mortgages stay expensive longer than expected. Credit card rates don't fall. Auto loans remain tight. Rents rise as landlords refinance at higher costs. Wage growth slows as companies protect margins. There's no crash, just pressure. Spreading slowly, evenly, persistently. This is why pre-collapse periods confuse people. Nothing looks broken, but momentum fades. And by the time options disappear, the structure is already set. This is why 2026 matters. Not because something must break, not because a crash is guaranteed, but because this is the first time since 2008 that the entire global financial system is being tested at once. Back then, the stress came from one sector. Today, it comes from everywhere. Governments must refinance, corporations must refinance, markets must absorb higher costs, households must adjust. At the same time, this isn't a crisis of confidence yet, it's a test of structure, a test of whether a system built on cheap debt can function when debt is no longer cheap. There's no obvious pressure valve. Rates are already high. Debt levels are already elevated. Central banks have fewer tools. Governments have less flexibility. So the system doesn't fail by collapsing. It fails by tightening. Choices narrow. Margins compress. Growth slows. Not dramatically. Persistently. And whether the system holds or reshapes itself depends on one question. Can global debt be refinanced at today's prices without breaking the incentives that keep the system moving? That question won't be answered in a week. It will be answered over years. And that's why understanding this moment matters before anything visibly breaks. In the next video, we go deeper, because when governments can't refinance easily, they don't panic. They adapt. And those adaptations, taxes, inflation, spending cuts, financial repression, shape everything that comes next.